old enough to remember the 1970s, and I do think, and I've been writing about this for several years, that this decade is going to be quite a bit like the 1970s. And there were times when the economy cooled, inflation came down, the Fed did cut back and then inflation took off again because there were underlying structural inflationary forces pressing upward, and I think that's what we've got right now. So I think any reprieve that we get on inflation, any decline in interest rates, any rally in the bond market, all going to be relatively short-lived.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. We have a super important discussion lined up today that I'm very excited about. Today, we're fortunate to have with us David Hay. David is the co-chief investment officer and founder emeritus of EverGreen GaveKal. David has been in the securities industry since 1979 when he joined Dean Witter Reynolds, now Morgan Stanley. He's also a published author with his most recent book titled Bubble 3.0, Who Blew It? And How to Protect Yourself When It Blows Apart. David, thank you so much for joining us today.
Thank you, Gary. Well, those are glowing words, although it's kind of sobering to think back to 1979 when Jimmy Carter was in the White House and putting solar panels on it. And he's still going, which is pretty amazing. I think he's going to break the world's record for hospice care, but good for him.
It is amazing that he's still going. So, David, the U.S. has been nearly running wartime deficits of 6 to 7% the last few years, generating $1 trillion in new deficits every 100 or so days. It's been a federal fiscal funding fiasco, but likely the main reason why the economy has been so resilient. The transition to a growth slowdown has now just begun. And since inflation is still well above target, while the unemployment rate is still quite low by historical standards, the Fed seems to be likely to be slower to react to this growth slowdown, which actually could increase the likelihood that the slowdown is going to become worse than expected as we move into next year. What does your analysis show on this?
I think that's pretty accurate, Gary, and I'm smiling because you used my 4F phrase of the federal fiscal funding fiasco, but it is a fiasco. I actually just signed up for David Stockman's newsletter, which he's been just raging about this, and of course he was the wonderkind in the Reagan administration. So yeah, it's a huge problem, and I think the Fed is in a very difficult situation, and you could kind of see that yesterday, where the inflation number, that was a good number. Now I think you and I have suspicions about how long it's going to stay that subdued. But if we do have a recession, the odds are inflation is going to cool further, just as it did in the 1970s. But then the question is, what happens to the deficit in a recession? I mean, does it go to 4 or 5 trillion? And the fiasco becomes much more of a fiasco? It's almost incomprehensible, really, what could happen, because you're right. I mean, Keynes gets a bum rap in some ways, John Maynard Keynes, because during the 30s, he was advocating that the government needed to run deficits because the private sector was shell-shocked and there was too much savings, there was overcapacity, et cetera, et cetera. But the other side of his economic platform was that during good times, you should run surpluses. He would have been appalled to see the kinds of deficits we're running that are really like what you would be doing during a depression or wartime when you had sub 4% unemployment. And now, of course, unemployment's rising. And I think it's an interesting issue that now that we're up from 3.4 to 4, so it's 60 basis points, 0.6% increase. The Fed is modeling we're going to go to 4.4, I think it's by the end of the year. We've never not had a recession with that degree of unemployment increase. And yet, they've got this situation where, do they cut rates now, given inflation that's still running at a relatively high level? And one of the things that I think is really a challenge is when you look at average hourly earnings that are still running at 4%. And earnings are a huge part, wages are a huge part of the cost level. So they've really, as I've said many times before, the Fed has really printed themselves into an extremely difficult corner.
It's a good way of saying it. Yeah, so staying on this inflation front, David, rising prices for goods and services, they're a major concern globally and specifically in the U.S. it's straining household budgets of the lower 50% of the economic ladder. We see that in all the metrics. And on the other side, it's kind of really pressuring the central banks to raise interest rates further, although they're not doing that. The Fed really needs to wait longer before acting in order to be sure that inflation's been slayed. However, it seems like they've had an asymmetric policy stance where the bar to cut is lower than the bar to hike. And that's created extraordinarily loose financial conditions, which has bid up asset prices, and it's made it much more difficult to get to that 2% inflation number. In your analysis, will inflation remain elevated for the long term? What will the Fed do with rates in this election year? And what impact will their actions have on the markets?
Well, as we discussed right at the outset, I'm old enough to remember the 1970s, and I do think, and I've been writing about this for several years, that this decade is going to be quite a bit like the 1970s. And there were times when the economy cooled, inflation came down, the Fed did cut back then, and then inflation took off again because there were underlying structural inflationary forces pressing upward, and I think that's what we've got right now. So I think any reprieve that we get on inflation, any decline in interest rates, any rally in the bond market, all going to be relatively short-lived. I think by the way, I should say that from 1981 until the summer of 2020, I was almost 40 years a bond bull most of the time. I kind of built my career on the belief that we were in a disinflationary period and that, Volcker had crushed inflation. Interest rates they were like 9 or 10% in real terms during his 1981-82 blitzkrieg against inflation, which was highly successful. It was very painful, but we had a very low debt levels back then, so we could do that. When you have debt back then, the debt to GDP was about 30%. Now it's 30% with a one in front of it, 130%. Very tough to get interest rates up to a level that is truly anti-inflationary. But another change, which I've been slow to recognize, but I think is valid, is that these higher interest rates do actually create a bit of an upward pressure, at least on the economy, though it's very bifurcated. And to explain that, if you have the wealthy, which is obviously a small percentage of the population, are feasting right now. I mean, they're making money on their stocks. They're making high interest rates on their money market accounts, trillions of dollars in savings that was basically earning nothing, a few years ago. Now it's generating 5%. So that's stimulative to the economy. Now, the flip side of it is that, for most Americans, and what I think is most troubling is for the small business community, these higher interest rates are not good. They're very painful. I mean, as you know, credit card debt is well over $1 trillion. The credit card interest rates are 24%. Small businesses are borrowing in the 9 to 10 to 11 to 12% range, which they can't afford to pay. The small business community is the number one job creator and destroyer. And there are now spreading business failures, mostly of the smaller kind. So I do think that I think that the economy is not as strong as perhaps Jay Powell indicates, like in his presser yesterday. I think there's some real weakness to this economy. But for the rich, it's great.
Well, and that's a really good segue for this next question that I have for you. In March of 22, the Fed began raising interest rates to combat inflation, and it resulted in the fastest, steepest rise in rates in recent Fed policy history. This type of action typically would slow economic growth and potentially lead to a recession. It didn't happen for all the reasons you just mentioned. On the wealthy side of the coin, the amount of money that was pumped into that group, giving them the ability to feast and spend on assets and then that trickle down. So it's been resilient because of that. But are we finally at the point where the long and variable lags of monetary policy tightening are hurting a large enough portion of the economy to overwhelm the benefits that we've seen on the flip side? Not to mention the homeowners who've been locked into low rate mortgages and corporations that had borrowed cheaply during the pandemic. I mean, a lot of that is starting to unwind, except for the mortgages.
Yes, I think that's a very good point, is that the private sector, unlike the public sector, took advantage of the collapse in interest rates in 2020 and 21. I mean, in the summer of 2020, the 10-year U.S. Treasury fell to basically 0.5%. And that's what really caused me to say, hey, this bond bull market that's run for 40 years is over. And plus, inflation was already starting to accelerate, and it became much more apparent in 2021. So, yes, I think that you're right that now some of these, like the junk bond refinancings that happened on that back in that era, are now starting to come due. And also, there's a fair amount of variable rate debt out there, not just credit card debt. And a lot of this private credit, as you know, the shadow banking system, which is basically built around private credit, those are almost all variable loans. And I do think that there is kind of this, as you said, this lag effect where the rates go up sharply and it takes a while for things to reset. And yet, conversely, for those people that are receiving these high interest rates, that benefit hits pretty immediately. So I do think we could be at a point where it starts to swing, where the rich are not going to get it, and we're not going to get more than 5%. But I think the other part of your point is that played a fairly significant role in the deficit blowout that occurred last year, because a big chunk of the deficit increase, I think it was about half a trillion, was because of these higher interest rates. That Treasury debt rolling over at higher and higher rates. So that created stimulus. Whichever way you want to look at it, the fact of the matter is the federal deficit doubled last year. So when people say, how come we didn't have a recession? It's very, very hard to have a recession when the federal deficit doubles year over year. But now we're actually in a situation where the deficit, while it's still huge, is shrinking. And this is, I know, a hot debate whether it's the total size of the deficit of, call it $1.5 trillion, which is still immense, or is it the rate of change? And I think there's arguments to be made both ways, but I think it's not going to be as stimulative as it was last year. I think it's a pretty safe comment. And then you're starting to see some of these other negative effects really start to kick in. And I think the jobs market is not nearly as strong as what people believe it to be. I mean, if you look at the difference between the household survey, which is much better historically at inflection points, and the official non-farm payroll everybody looks at, household survey is telling a much darker story, and I think a much more accurate story.
So let's stay on that jobs issue for a moment here. Recently, a Bloomberg economist writer wrote that the Fed overstated their employment numbers by more than 730,000. And that was followed up by the JOLTS report coming out showing job openings cratered. What are all of these data sets saying to you? And do you believe an unemployment event or a significant rise in unemployment is on the horizon?
Well, it's already happening. I mean, it's as I said, it's gone from 3.4% to 4%. That's a significant increase. That's historically coincided with recessions. But I think it's actually worse than that in reality for some of the reasons you were touching on. One of the big fudge factors is this birth-death model that the government relies on heavily. And it's not a conspiracy theory thing. They don't do this with any malintent, I don't believe, is that they assume a normal level of business formations. And it's fine when things are kind of in equilibrium. But when the economy is turning down, or when you're getting a spike in business closures, which is clearly happening, then the birth-death model is wrong. It's probably double wrong, because it's actually assuming business creation when there's business destruction going on a net basis. But don't believe me, look at the revisions. I think the revisions really tell the story that almost every single one of these months that's been reported that has looked very, very strong from a job standpoint have been revised downward. So, and if you look at full-time jobs versus part-time jobs, full-time jobs being destroyed, I think about 1 million over the last 6 months or so. And the part-time jobs, I think, are up by 600,000 or 700,000. So it doesn't look great, really, if you do a little bit of digging and don't just take the numbers, at face value.
Yeah. The picture that's being painted is it seems to be getting a little bit more dire, and some things are being hidden because of there seems to be an illusion that things are better than they really are.
Yeah, so I think that's true. I think that so much of what we've got is pseudo prosperity. Can you really create prosperity out of what was not only a tremendous fiscal stimulus, but also monetary stimulus? Now, so we were doing effectively back in 2020, 21 into 22, MMT, modern monetary theory. So the government ran massive deficits, and the Fed financed those deficits with its printing press, which is an exaggeration. They don't actually print currency, or not much of it, but you know what I mean. They create these reserves out of nothing and use that to buy government debt. Now, obviously, the Fed is trying to be restrictive, and they're trying to undo that. But once you let that inflation genie out of the bottle, it's tough to get it back in. People's expectations get kind of entrenched. I think almost all Americans believe that the price level has been understated. My wife is very adamant about this. That when she goes to the grocery store and she looks at these prices versus what they were pre-pandemic, she goes, some of these things are up 100%. And,
Yeah.
and in a more modest sense, up 50%. And yet the government statistics look way lower than that. And actually, the Wall Street Journal had a good article on it just the other day, talking about how, even though inflation is decelerating, the overall price level is still so high relative to what it was pre-pandemic that they're not happy. And as you pointed out, for the lower middle income people, these price levels are not affordable.
Mm-hmm. Yeah, and it seems to me that the exercise of MMT and the hidden dangers that are lurking, there's only a small subset of people that are paying attention on a high level to what's really happening. And if the economy were to turn fairly quickly downward, it's going to catch a lot of people by surprise. Because they do think everything's great.
Well, and there's an incentive to look at the stock market and say, well, hey, the stock market's making new highs, so that's telling you that the economy's fine. But the stock market was making new highs in 1929. It was making new highs at the end of 2007. So the stock market gets these things wrong, quite often. And of course, as you know, the stock market has had very narrow leadership. I just saw a chart of the difference between the cap-weighted S&P and the equity-weighted S&P, and it's like almost at a record low. So there's a whole bunch of stocks that haven't gotten the prosperity boom memo.
Yeah. Well, to your point, I was talking with Larry McDonald yesterday, and he was telling me that 3 stocks make up 20% concentration. So there you go. So I have a geopolitical question for you.
Oops.
David, the war in Ukraine and other geopolitical conflicts, they're a great source of uncertainty and concern globally. In recent weeks, we've heard that President Biden has okayed the use of U.S. manufactured weapons against and inside Russia to help in the conflict. We've also heard the Russian President Putin speak on their nuclear policy and essentially warning the U.S. and others that they aren't afraid to use their nuclear weapons. And now Russia's decided to do military training with warships and nuclear subs right off the coast of Cuba, about 90 miles from the U.S. shores. In your perspective, where do you see all of this conflict going, and what impact will this have on the markets and commodities specifically?
Well, I'm the first to say I'm no geopolitical expert, but I'll also say that I'm old enough, believe it or not, to remember the Cuban Missile Crisis, which is what you're talking about is eerily reminiscent of that. And it is, I don't know how this thing's going to turn out. I believe Putin is bluffing, but it's, obviously that's a very dangerous position to take if one is wrong with that optimism. I mean, if he really is going to deploy even a tactical nuke, the consequences are just almost unimaginable. Again, I don't think it's going to happen, but just to prove my lack of geopolitical expertise, I didn't think he would invade Ukraine either. Though I did say that if he did, it would be a huge mistake, which I think that part of it's turned out to be true. But it's just a very, very unstable world out there. And that's what I find is, in fact, I always say the great something. And in this case, it's the great disconnect between these very frothy, at least at the superficially financial conditions and markets versus all these huge, in some case, existential threats that we're facing. I know when it comes to nuclear war, people, don't worry about that. If it happens, we're all gone anyway. So, buy stocks. But, then if you have a less draconian situation where nukes are employed, but on a limited basis, that's probably where you get the really, really nasty market reaction. Again, I don't think that's going to happen. I think there's other more plausible threats, which frankly, just look internally at what's happening with the enormous amount of division that we have in this country. In fact, I know Jeff Genlock is on a big theme about this is 1968 all over again. And again, I'm old enough to remember, the Chicago riots during the Democratic National Convention in 1968. Supposedly, the protesters are mobilizing, like a factor of 10 more protesters to hit the streets during this year's Democratic convention. And of course, we've got a a potential new reelected president who's been convicted of a felony. It's just
right.
And then the president's son, he's convicted. So it's unfortunately, I think we've weaponized the legal system, and what it's doing is just serving to further divide America, which is already incredibly divided.
Yeah.
So there's the potential for really serious social unrest. I think that's what we should really be worried about, in my opinion.
Yeah, and I'm with you on that. And between the political situation here in the United States, the geopolitical situation, seems like both of those scenarios are doing nothing but ratcheting up. The deeper we get into this, nobody's got cool heads. Nobody's settling things down. Nobody's willing to walk away from the fight. Everybody is taking it one step higher here as the weeks and months go on. So where does it end? I guess we'll find out. But the uncertainty, the volatility, I think those things are all rising. So, David, the U.S. is now 36 trillion in debt. Like we talked about, over $1 trillion per year in debt servicing costs, headed to 1.7 trillion sometime in 2025. Deficits are running about $1 trillion every 100 days or so. This is forcing massive treasury debt issuance at a time when countries like China, Russia, Saudi Arabia, Japan, and others, they're cutting back on U.S. debt purchases or they're net sellers. What impact will this have on the debt market? And do you expect a substantial portion of the debt to have to be monetized by the Fed, leading to a devaluation of the dollar?
That's a complicated question, or series of questions. I think the basic answer is yes. I don't see how the Fed can avoid being not just the buyer of last resort, but perhaps the buyer of first resort. And what I think that's particularly going to become apparent is in the next recession. Before that, they might be able to escape it. And I will say, I kind of touched on this earlier, but you used the number $1 trillion it was actually every 100 days. And that was true. However, that has slowed down. There has been a surge of tax revenues that have come in here recently. And I think you could put that right at the doorstep of the stock market, or maybe even cryptos and how much money people have been making on their cryptos. I guess some of those guys pay taxes. So there is kind of this temporary relief, but it's temporary. It's transitory, to use one of Jay Powell's former favorite phrases. And at some point, I think we're going to have those deficits blow out again and get even worse than that's been the pattern. If you look at the deficits in each of the recessions, they get larger and larger and larger. So, to expect a $4 to $5 trillion deficit, where is the money going to come from for that? Now, I think at the short end, there's quite a bit of demand. But at the long end, there's already been a lot of signals that the bid just isn't there for long treasuries. Now, some auctions go okay. Other auctions are very disappointing. And I do think that when there's this perception of decelerating economic growth and inflation, it's easier for the 10-year to get in a bid. But again, that's what happens if you get too much of a bad thing and these deficits go absolutely postal. And then who steps up? Because you're right, the foreign central banks have been, if anything, net sellers of treasuries. It's pretty clear the dollar is being gradually replaced as the reserve asset of choice. And it's really not so much the dollar, but treasuries being replaced as the reserve asset of choice by gold, by most foreign central banks. And I don't think the typical American realizes that. I mean, if you look, and I'm sure you're well aware of this, outflows out of the big ETFs, the gold miners are absolutely detested. U.S. investors are so focused on NVIDIA and AI plays that they're not really perceiving this. It's a major paradigm shift that's underway. So it's I think the Fed's going to really have its hands full.
Well, let's talk about that paradigm shift. Long depressed and long overlooked, the commodity asset category, it's been waking up little by little. And on some charts, the commodity complex, though, it's still historically undervalued. Some even believe that we're on the cusp of a commodities super cycle. Are you anticipating and positioning for an investment rotation on some level from general equities into commodities? And what do you see coming for commodities over the next few years?
Well, getting back to what I said earlier, I think this decade is going to look a lot like the 1970s. And if you had, in the early 70s, there was a very, very frothy market environment as well. That's when the Nifty 50 was very popular. And, by today's standards, those multiples look kind of modest. the Nifty 50 in many cases was trading at 50 times earnings. Today we've got, many, and I'm not even really talking about the Magnificent Seven. I think the Magnificent Seven are, too crowded, too popular, but they're not outrageously overvalued. I think the outrageous overvaluation is the next level down, though some of these things have been taken outside and shot here recently, like MongoDB, but all these companies that are trading at 100 times earnings, 200 times earnings, if they have any earnings. Mm-hmm. So that was where the real wipeout happened in 2022. Then you've had kind of this echo bubble. I think those things are going to get blasted. And I do think that commodities are very attractive, particularly on pullbacks. And that's what we've had. And one of the points that I make in my writings and whenever I speak is that, or usually when I speak, is that when commodities run hard, when you get a big rally, take some money off the table. And that way, when they pull back, because they are very volatile. I mean, you probably have seen the charts of gold in the Weimar Republic in the 1920s. You would have thought it just went straight up, but it had some vicious corrections. Even as the what was it? The Reichsmark back then was, going to nothing. So you just have to be, I think you have core positions. And I'm going to give you a good example. So back in 2020, coming out of COVID, we really loaded up on the gold miners, particularly the junior gold miners. They went absolutely nuts. Never made so much money for clients in such a short time. But we took should have taken even more off the table, but we basically cut the position in half, which was the profit. And, then it was like 3 years of, going sideways to down. And then lately we've had a bit of a rally. I think we're in the early stages of another rally in the gold miners. I think they're way too detested right now, but these things don't go in a straight line. Look at uranium. Uranium doubled basically from a year ago to where it peaked out earlier this year. And then it's come down, 25%. And I think it's back into a buy zone. I think the uranium fundamentals are extremely positive. Copper looked like it was breaking out, and then it's pulled back hard too. And I heard Jim Cramer on CNBC making fun of anybody that believes we're in a super cycle for copper. So I guess he should make fun of me because I think we are. I don't think it's going to be quite as powerful as we maybe thought at one time, because I do believe EVs are losing momentum. I think they're losing the green energy automotive solution, frankly, to hybrids. I think hybrids are where you're going to see the really rapid growth, which creates an
okay. So there's several things there that I definitely want to touch on, from the uranium to the gold, and a few others, and the copper. But let's look at it more of a higher level on the energy side for a moment. Since 2014, CapEx for energy companies is lagging by some estimates as much as $3 trillion for multiple reasons, including the big one, ESG. In other words, there hasn't been nearly enough good old-fashioned investments in coal, gas, uranium, oil, and metals exploration and production, especially in the North America area in the last decade. And over the same time frame, global population has grown by almost 1 billion people. Plus, there's millions that need to move up the economic ladder in the Asian region. What is the impact of this $3 trillion investment shortfall on energy and supply at a time when energy needs are clearly exploding? I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals, miners, and all the expert interviews, just like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with David as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video.